Hey guys, Stock Saturday, and it's been a real roller coaster of a week. I'm actually flat, which is sort of a lot worse than I would imagine a lot of people are doing, because I'm not very sort of tech stock heavy. Although you can see some sort of fair greens on here today, which I will come back to, but it's largely sort of semiconductors feeling the benefit this week. But let's have some look at some news. So we got Tritax Euro boxes results. I've got a bigger position in them than Tritax Big Box, the UK one, because I see the Euro box as sort of slightly better value, and their results don't look too bad. Sort of the standard EPS is down, as you'd expect. That's sort of reflection of the portfolio dropping. So portfolio value has come down from 1.7 billion to just under 1.6 billion, but adjusted earnings per share is up, which is good. Rental income up. Obviously they're diluting, so you don't really look at just rental income. You want to look at everything if you can on a per share basis, but we don't count a drop in portfolio value as negative profit. So I think adjusted earnings per share and obviously the dividend, assuming they can afford it, is sort of better to look at. You don't really get adjusted funds from operations figures like you do in the US for a lot of the UK ones, but they sort of use their adjusted earnings per share. And yeah, we've had 100% rent growth, which is good, but some people sort of trailing off and not renewing leases. Vacancy rate up to 5.4%. They don't actually have that many tenants, so building properties and not necessarily having them rented out just yet, can sort of all come into it. And yeah, 5% vacancy rate isn't ideal, but it's a lot better than some of the sort of office REITs and other sort of less in-demand REITs. So yeah, nothing too bad. Loan to value ratios come up 45%. Again, sort of not a huge issue. So you can come down to their customer base. They have 36 customers in total, but the sort of top 10 make a huge amount of that total. Mango actually being the largest now, above Amazon. Mango sort of clothing retailer. You've got Puma in there, pretty good name to have. Lidl, certainly not going away. Wayfair, Action Logistics, and people like that. So yeah, it's diverse, but sort of also a reasonable amount in the top 10. Just looking at the balance sheet as well, cash sort of slightly down, 62 million euros, and debt slightly up to 770 million, but nothing sort of too much to worry about, I wouldn't think. Basic net asset values decreased, obviously, with the portfolio dropping, but yeah, €1.02 at a 62-cent share price. Pretty good, so I still think this is reasonably good value, and as long as the vacancies don't start sort of creeping up or the rental income comes down, then I still think solid. And we've had Alibaba's results come out, sort of bit of a mixed bag really, not what you'd expect from a tech company certainly, and sort of they're differing from Amazon. They get called the Chinese Amazon, and it's sort of very, very different to them at the moment. So total revenue up 2%, which isn't good at all. This has been hit by Chinese lockdowns, I guess, although March, January to March 2023, wouldn't have thought would have been that bad. So they're getting hit by sort of competitors coming out, as I understand it, in Chinese commerce, your sort of JD.coms and Pinduoduo and others. But international commerce doing reasonably well, 29% up. But this is sort of a much smaller segment. local consumer services, and Kainio, which is the logistics side, both up. Cloud down, which is sort of disappointing. Again, you want the sort of this to be a growing section, competing with Amazon and the like, and sort of being big in the Chinese side of that. You want their cloud side to be growing, but I guess they're going to struggle. Possibly chip shortage. I don't know whether that's having a bearing. We'll have to have a bit of a deeper dive, but it's not a huge position and sort of not something that I'm looking to build up just at the moment, even though it is sort of considered very cheap. I do sort of prefer elsewhere. It's the adjusted figures that are sort of making the headlines. Adjusted EBITDA 60% up. Obviously, last March 2022 was a very bad quarter, so it's easy to make money in comparison. 35% up earnings per share, but the actual net income is down. And on the year, 44% up even on net income. So, compared to last year, I think it's easy to compare to last year, really. So, things are doing well, but really should might have a look back and sort of compare to 2019 and 2020, because I don't think China were sort of really in a all that harsher lockdown for, or certainly part of 2020, but maybe 2021, where they sort of opened up a little bit. But, Tencent is my sort of favoured Chinese stock at the moment, so I will stick with them through process. Balance sheet at least has improved slightly, which is nice, largely due to investments going up in value. The actual cash itself has come down slightly, but still does give them a very solid net cash position. So, I can see the sort of value argument for them, and if they can sort of carry on growing over the years, then it could be a good investment, but I just don't like the sort of heavy competition there. So, it's one that I'll sort of keep an eye on. I'm not selling my position, but not really looking to add too much at the moment. One that has caught my eye is Embracer Group. I mentioned this a few times, that I'd had it on my sort of watch list and been looking into them. I like the sort of portfolio, and sort of I don't necessarily like some of the games that they make, but it's sort of quite a diversified portfolio. And then they have the tabletop games side as well. But they've just been absolutely hammered. They were sort of looking into a strategic partnership, they call it, which would bring around $2 billion in revenue over a number of years. They haven't sort of said who this would have been, but this deal has essentially collapsed. And I was still I never really took all that much notice of this strategic partnership until it was sort of fully announced what it was. And I kind of was buying, or looking to buy them, sort of because of the portfolio of IP, really. They now own the sort of Lord of the Rings basically holding company, so they have full rights to any sort of tabletop games, video games, and I think even some TV. I don't think they have the main films, if they release any more large big budget films, but certainly sort of smaller TV shows and that sort of thing. And then they have the Tomb Raider sort of Square Enix assets that they bought. And as far as I can tell, they are still in a deal with Amazon to be making the next Tomb Raider game. So, the fact that this sort of, whatever the transformative partnership was, has collapsed, I don't see as all that big of an issue. They've heavily dropped their earnings forecasts, but sort of 7 billion to 9 billion Swedish, and they're now dropped to 28 billion Swedish in market cap. So in adjusted EBIT terms, it's sort of 4 times earnings. This is sort of a heavily adjusted EBIT. If you look at sort of net profit, it's horrendous. So you have to sort of believe their adjustments. I'm sort of in two minds about it, but I mean 4 times earning. It doesn't need to be 4 times earnings to be a buy necessarily. But yeah, a drop of 45% just on this alone seems a little bit extreme. I don't think we should be looking at just this year. The sort of portfolio they've got coming up still looks very good. So it's a little bit like a REIT in that they're sort of heavily diluting, and the sort of year-on-year figures aren't to be looked at too much, but they are still growing. Revenue in a challenging market, you could call it. Net sales growth 121%, but yeah, adjusted EPS after full dilution is 4 Swedish krona. And they do have some big names. So, Dead Island has just been released. Dead Island 2, I believe, 2 million units sold. They don't do the sort of huge numbers that I'm used to from other studios. Your Nintendos and obviously Activision and people like that. But then they're what is now $2.5 billion market cap. And yeah, still got announced partnerships with Warner Brothers, Amazon Games, and whatever they're going to do with the Lord of the Rings franchise. And then sort of other sort of reasonably large games, a Warhammer game and Payday 3. Payday 2 was sort of very popular. So yeah, I still see this as very positive. And then the tabletop side seems to be doing better than video games. Certainly, it's just a sort of solid industry that weathers the recession even more than video games, it seems. What I really do like about the tabletop side is that they just have so many of the big names for sort of what is such a small market cap company. You got Star Wars, Marvel stuff, Squid Game, Stranger Things. They have sort of deals with Netflix, bringing their games, their sort of series into games, and yeah, I just see that as incredible to be sort of partnering with some of the biggest entertainment firms in the world. So a decent pipeline as well. Star Wars trading card game coming next year. So yeah, the tabletop side does sort of interest me quite a bit. Well, as I say, not one that I've bought just yet, but certainly with this drop, I am looking at taking a position. It would have to be on Interactive Brokers because they're not on Trading212, so that's a bit of a pain, but it's not something that would hold me back, certainly, and I've been sort of making some cash available, so we'll see. Might be able to sort of pick this up in the next couple of weeks. So just looking at the news for the week, didn't really have all that much. Tuesday had some sort of house building data, building permits down quite a bit, so whether that's a bit of a slow up in new houses. New houses sold were better than expected, but could be a bit of a sort of leading indicator to say future sales may not be quite as rosy. And then Wednesday had absolutely shocking inflation data from the UK. These are shown as green still. They're, I think that's investing.com's mistake of the number being green, or the number being up being good. So that's maybe their mistake. But core CPI inflation for April, 1.3%. So this is, we're trying to go for, similar to the US, a target of about 2%, and 2% for the year, and we've got 1.3% in a month. So we're still accelerating, 6.8% on the yearly now. People have looked at the sort of standard CPI on the year coming down from 10.1% to 8.7%. Was expected to come down to 8.3%, but they're saying inflation has peaked and we're down to 8.7% and all that. But yeah, I think that's sort of looking too far in the past. I mean, you're comparing to April 2022, it's sort of a month and a half after the war started. I think we need to be looking at what's happening now. And what's happening now is 0.9% core inflation last month and 1.3% this month. So 2 months alone is more than the total annual target. And if it was coming down, you wouldn't have these two numbers. So that's terrible. And then Friday, you had the US, Jerome Powell's favourite indicator, the proper inflation, core PCE for April. This comes out later than the CPI, but they seem to prefer it. And that, again, has sort of ticked up ever so slightly. Was expected to stay flat at 0.3% again, but it's 0.4%. And so on the yearly, that ticks up to 4.7%. Again, they want this at 2. So whether we're going to get yet another rate increase from the US, I'm not sure. But yeah, I expect he would take this as rough. We'll probably wait for some May numbers. But yeah, see what we get in June. Could be a bit rough, especially with their debt ceiling issues and everything. Be interesting to see what happens. But just looking at the portfolio, so the invest account is what's doing the business at the moment. Nvidia is sort of rocketing up at the moment and seems to be taking some semiconductor stocks with it. So Broadcom seems to be one of the sort of big beneficiaries. They have signed a deal with Apple, which people sort of thought they were going to be losing a fair bit of Apple business, and they've signed a multi-year partnership. So it could be sort of fears basically just going away from the stock and doing well. But I do think this is also part of sort of the AI side, data centers. There's going to be more data centers to do with AI, and Broadcom do chips for and switches and things for those servers and data centers. So yeah, they've been doing really well. 11.5% up just on Friday is a little bit crazy, but yeah, 19% for the week. This doesn't show the FX. Actually, I'm actually 100% up on my position, so that's been pushing it really well. The other one is Taiwan Semiconductor, not up quite so much on Friday, but it's 12% up on the week, and now almost my largest position. So again, very, very nice. Tencent been sort of doing okay. And Meta Platforms as well is now about 41% in the green, including FX. And I'm not sure they're going to get sort of a huge benefit from any of this AI stuff, and I'm not entirely convinced on why this is rising. So I've been thinking of selling this for a little while, and may sell half of it or something, and because it's quite a big position. One that was smaller is Micron, and I did sell that off completely. A little early. It's down there at nearly $74. I sold it at about 68, I think. So yeah, a little bit early to get out on that one. Rose 6.2% with all of these other rises, but yeah, there you go. I can't see. I think people are looking way too far into the future on that. So yeah, I think if the whole market's going down and they're coming out with quarter after quarter of we've lost, $1 billion, $2 billion this quarter, I just think people are going to maybe sort of forget about the future a little bit and give that one a bit of a kicking. So yeah, it's interesting move. So I have got $4,000 sitting there. Part of this could get moved out over to Interactive Brokers to be buying other things, or part of it maybe going into the ISA. So I still haven't subscribed at all to the ISA, and need to be doing something with it at some point, but I did sell a bit more of the treasuries down to £7,000 now. I'm kind of sort of dollar cost averaging out of this because it's just been flat, which was sort of partly the point, a little bit of income and just a bit of sort of ballast in the portfolio for things while they're going down. So sold £2,000 of that, and again put it into Equinox Gold and Core Mining. So I need to adjust the order of these now. Core is sort of quite a bigger position now, as is Equinox Gold. So those are the two that I'm sort of seeing as pretty good value at the moment. I didn't want to be increasing First Majestic certainly, or Fortuna. I think sort of Core and Equinox have sort of better mine life and a better mix really. Or Equinox being entirely gold, but I just think that is very, very good value. But Core have the sort of longer mine life of silver. So yeah, interesting in there. No change at all in the IG ISA, and no change in the Chinese tech, although it's up sort of a couple hundred quid. So that is the portfolio for the week. Let me know how you guys are doing, if you've been part of this semiconductors rally, and if you're buying anything. And yeah, subscribe and join the free Discord, and see you soon.